Corporate Treasury just got a clearer rulebook for digital money, and the focus is controls, not crypto hype. Tokenized cash sounds futuristic, but treasurers care about basic operating questions first. Can the company account for it? Can approvals still work? Can balances stay private? Can money move across banks without locking the company into one vendor? TCMAG is trying to put those questions at the center before digital cash products scale. That standard is harder than launching a crypto app because Treasury errors can affect payroll, vendors, liquidity, and board-level risk controls. The multi-bank point is especially important. Large companies do not run cash through a single relationship. They use several banks, payment providers, systems, and jurisdictions. A digital money product that works only inside one issuer's system creates dependency and operational risk. The principles push for multi-issuer, standardized designs so corporate users can avoid vendor lock-in. That is a very different problem from making a token move quickly on a chain. Standardization matters because a company may need to move funds across regions and providers without rewriting every approval process each time. Accounting and integration may decide adoption before speed does. A Treasury team needs clear classification, valuation, disclosure, and audit treatment for any digital instrument. It also needs that instrument to connect with existing Treasury management systems and ERP platforms. Digital money cannot ask corporate finance teams to abandon the systems that run payroll, vendor payments, cash forecasts, and approvals. It has to fit into those systems with standard interfaces. Tokenized Treasury products will also need clean reporting so auditors, controllers, and finance teams can see the same cash position. The adoption barrier is paperwork as much as code, because finance teams need controls that survive audits and month-end reporting. Security is more than a password or a private key. Corporate Treasury relies on maker-checker workflows, segregation of duties, approval hierarchies, audit trails, and controls that prevent one person from moving money unchecked. Confidentiality matters too, because balances and transaction data can reveal business-sensitive information. If a digital money rail weakens those controls, it will struggle with serious corporate users even if the settlement technology is fast. The strongest systems will make new key management risks visible rather than hiding them behind a sleek interface. For corporates, that is the difference between a technology trial and an operating tool that can sit beside bank accounts, ERP records, and Treasury policies. The 24/7 promise is powerful but demanding. Removing cutoff times, bank holidays, and time zone delays can make cash movement more flexible. It also means companies need monitoring, dispute resolution, error handling, and operational support outside normal banking hours. Settlement finality is the legal piece. Once money moves, the transaction has to be recognized as complete. Settlement speed is useful only when legal and operational certainty come with it. Always-on movement also changes staffing and controls, because someone still has to approve, monitor, and investigate unusual events. The next tokenized signal is product behavior. Watch whether stablecoin issuers, tokenized deposit providers, money market fund token issuers, banks, wallet firms, and enterprise software platforms build around these principles. The advisory group can publish a framework, but corporate adoption depends on products that pass real Treasury checks. The winners will be the systems that feel less like crypto experiments and more like reliable cash infrastructure. The real adoption signal will be corporate users moving routine cash functions, not just vendors announcing that the rails are technically possible. The framework also puts pressure on vendors to explain reversals, dispute handling, and downtime procedures before Treasury teams depend on a new rail for everyday cash movement.